Okay, we're back for the next part of the workshop, and we're going to go into moving averages. And basically what we do is we have these plays kind of in order of how we look at them throughout the day. The first play that we look at during the day is the gap play, because basically that's the first play of the day. There's usually some type of a gap, but they're not always playable. And so we just went through and talked about the reasons why we would take a gap and fade it, and then the reasons why we would actually not take it in terms of a fade play, but actually go with the gap, which is a much rarer occurrence. That's a good question, Malcolm. Do the criteria apply across the board to the One Chicago list? Yes and no. I mean, here's what we'll do is we'll put together a kind of a criteria on each stock, but we're going to go through this on Monday. You'll see that there's some stocks like Intel and Microsoft that for them, for KLAC, the light volume is below 30,000 shares. For Microsoft, light volume is like below 100,000 shares. That's because it's a huge stock. KLAC represents more of an average. There are some stocks that don't trade any volume, so that's why we use those four stocks as kind of a main gauge. But we're going to go through all those on Monday morning when the market opens, and kind of give you a heads up and show you how they work. And we're actually doing more and more work on that, and we'll keep you guys informed, because it's something that's become more and more important to what we use, and it's just very vital to determining what the market's going to do on that particular day. Yep, exactly. And that's what I'll do too. Is the first thing I'll do is if I see one of my stocks that has high volume, I just go on Yahoo, type in the symbol, see if there's any news updates on it. If there is news like an upgrade or a downgrade, then I just throw it out. I want to see what the normal volume is. Is there a need? Do people feel a strong need to go in and buy stocks today, or do they need a strong need to sell stocks, or is it apathetic and nothing's really happening? Most of the time, it's apathetic and nothing's really happening, and that's when you get the gap fills. So that's what's kind of nice, to keep an eye on that pre-market volume. All right, so let's go into the next phase. What happens now is once the gap play starts, moving averages come into play. And for moving averages, we don't really use them so much for specific trading signals, because you're going to see that we've developed some indicators that are faster. Moving averages are more of kind of a lagging indicator, but they are very valuable, and we do use them basically to stay on the right side of the market. So let's just start going through the moving averages. And I'm not going to go through and read all this. This kind of just has kind of an overview on some of the technical analysis stuff that we do. But basically, what we're doing, the whole idea of getting into a trade and looking at a particular setup, is that you want to take the trades that have the highest probability of working out. Okay. Now we just went through all the criteria that we use for gaps to make sure that we've got a high probability trade, focusing on the actual pre-market volume, the amount of contracts that we're going to be using, whether it's full size, 2/3 size, or we're going to pass. So now, once you get past the gap play and you start looking at other plays, you need to start taking into account other indicators and other things out there that are being utilized. And what you want to do is basically get into situations where the evidence is on your side that the trade has a high probability of working out. So what I like to do with moving averages is it just kind of helps keep me on the right side of the market. All right, so let's take a look at some examples. I have a couple of different moving averages I like to use, but my favorite ones are both the 13 and the 21, the 13 and the 20, and then the 8 and the 21. All right, so I'll type those in: the 13, 20. And then the 8 and the 21. It doesn't really matter so much which ones you're using. What I have found is that you just want something that's kind of a fast-moving average and someone that's a little slower. And what I like to see here is that, is the 8, on this particular case, we'll talk about the 8 and the 21. And the idea is the 8-period moving average above or below the 20-period moving average or the 21-period moving average. Okay, so it's real simple. It's Sarah, what do you use to modify the EMA? What do you mean by that? I mean, basically what I do, like in TradeStation, is just you just set up exponential moving average, and then you have 8 or whatever periods that you want. Do you mean, do I use smoothing or anything like that? While you're typing that out, a simple MA is easy. Oh, okay. Do you mean? I got you. Okay. Yeah. Yeah. It just depends on the quote package you're using. By default, they're going to set up simple moving averages. If you're using TradeStation, you actually have to go in and choose exponential moving average. If you're using eSignal, you can go in and it'll ask you, okay, you want a moving average? Do you want it to be simple? Do you want it to be weighted? Or do you want it to be exponential? So you just need to choose exponential. I can tell you how to do it in TradeStation or eSignal. A different vendor may have a different way to do it. If that works, if that helps, sure, no problem. And the reason I like to use exponential is that it puts more weight on the current price action, so it responds a little bit faster than a basic simple moving average. So, can you hand me the glasses? Thanks. Okay, yeah. So on eSignal, when you just make the moving average, and then you go into edit. You go into edit studies, and then you can make it a exponential. So, in its simplest concept, okay, there's the whole idea of this is to keep you on the right side of the trend. So, when the 8 period crosses the 21, all right, this is just a visual telling you, hey, there's no reason here to try and short it. Just because the prices are higher doesn't mean you short. It's just saying, look, there's upward pressure, so focus on the long side. And there's kind of a misconception as to why stock prices move higher or lower. Okay, it has nothing to do with PE ratios or earnings or anything like that. It's all about supply and demand. And if the demand for the current pool of available stocks is greater than the supply of the current pool of available stocks, stocks are going to go higher. Okay, I mean, you could have lousy market conditions, but if there's if there's X amount of stock, and on this particular day, because whether it's short covering or whatever it is, if there's more demand for shares than there is the available supply, stocks are going to move higher. There may be 1 billion shares out there of a particular stock, but if there's only 40,000 shares for sale that day and 50,000 people want them, it's going to move higher. Okay, and if you think of it in that term, that'll keep you on the right side of the market because it'll keep you from second guessing what's happening. It's all about supply and demand, and the moving averages are an easy way of staying on the right side of the supply-demand time frame. If the 8-period moving average has crossed and is moving higher and above the 21-period moving average, then the demand is greater than the available supply, and prices are going to move higher. So in those particular instances, there's no reason to really focus heavily on the short side until that situation changes. And you can see when that situation changes right here, and all of a sudden the 8-period moving average crosses below the 21, now you're going to make more money focusing on the short side. Okay? Now that's it's a generality. You can set up specific plays off of these moving averages, but this is just a way to stay on the right side of the market and not fight the trend. And that's one of the things I've noticed that especially newer people do, is that they'll see a market that's going higher, like right here, and it's like, wow, this market is so extended and so high, I just got to short it. So, they'll start shorting it, and then what happens is they get stopped out. Well, that adds fuel for the next rallies higher. So you have people that, aren't following this rule. They're actually adding fuel to the fire because they keep shorting the market all the way up. Well, you don't want to be one of those people. You want to trade on the right side of the supply-demand cycle. And this is a way to stay on that side. Bradley, is there a specific reason as opposed to flat numbers like 10 and 20? Not really, Bradley. I mean, I've tried all kinds of different moving averages, and bigger picture, it's not too critical. You can use a 10 and a 20. For me, I've found that markets tend to stop in a strong uptrend. They tend to pull back and stop at the 8 period. So if you're using an 8 period instead of a 10, if you're trying to buy pullbacks, it gets you in a little bit earlier. Different things like that. But bigger picture, no, it's not a big deal. The main idea is you want a fast moving average and you want a slower moving average. And I'd say for a fast moving average, use between 8 and 13. For a slow moving average, you want to use between like 18 and about 21, 22. Okay? Do you have the EMAs on a 5-minute chart? Yeah, Larry, we'll talk about the time frames. I mean, we use those EMAs on all time frames. I use them on tick charts, 5-minute charts, hourly charts, and things like that. Yeah, aren't they fib numbers? Right. Yeah, that's actually a good question. I mean, and the reason I actually use the 8 period, the 21 period, because later you're going to see that I actually use the 89 period. Those are all representations of Fibonacci numbers. And so you'll see later when we look at the tick charts that we use, we'll actually be using 8 period, 21 period, and 89 period moving averages. And yeah, it's just because they're divisors of the Fibonacci levels like that. All right. Now you can see that first chart was a daily chart. On this one, you've got a 60-minute chart, and you can see that it moves the same. It's an 8 period and a 21 period. When it crosses to the downside right here, there's no reason to try to be a hero and buy the dips, okay? Oh, wow, this is falling down a lot. Let's try to buy right here. Oh, I got stopped out. Okay, let's try to buy again. Oh, I got stopped out. There's no reason to try to be a hero here. If the 8 period is below the 21, it's telling you that the available supply of stocks is greater than the available demand, and guess what? Stocks are going to move lower. So in this case, all you got to do is just focus on the short side. You know, anytime you get a short setup, you know, you take it. Whether it's a squeeze, whether it's a pivot, whether it's a scalper buy or scalper sell, you ignore the long setups and you focus on the sell setups in that situation. Conversely, when you cross back up here, this is telling you that the available demand for stocks is now greater than the available supply. So now you start ignoring sell setups and you focus on the buy setups. This is it's a very simple way to keep you on the right side of the market and keep you profitable to trade. Moving averages are generally a lagging indicator, so they're not as great for entries, although you can see here that if you would have shorted at this crossover and covered at this crossover, you would have made some decent money. Okay? But in general, what you want to look at, the more important thing is that if you're just focusing on intraday trading, okay, and this is a 60-minute chart, well, you know, one day of intraday trading, that's only a few bars right there, okay? So what you want to do is just say, okay, on the 60-minute chart, do we have a greater supply, or is there a greater demand? If there's greater supply on your intraday trading, just focus on short setups. If there's greater demand, meaning the 8 period is crossing up above the 20, then you focus on long setups. So it's just a way to kind of eliminate the lower probability trades from your trading regimen throughout the trading day. So it's just important kind of a heads up. Now, if you drill down and go to like a 15-minute chart, it's the same thing. What you want to do is if you've got, crossovers to the upside, then you focus on buy setups. You got crossovers to the downside, you focus on short setups, and so on. And so instead of taking these crossovers as buy and sell signals, you'll just sit there and say, okay, these are crossed higher, so now if I get a pullback to a pivot or I get a long squeeze, I'm going to go ahead and take it. Or over here it's crossed to the downside, so if I get a short squeeze, I'm going to go ahead and take it. So again, it's just staying on the path of least resistance on all time frames. Again, 5-minute chart. 5-minute chart's the same thing. One of the things that we'll also talk about later is the RSI indicators. As you can see here, we're looking at when you've got the prices making lower lows, and you've got like an RSI making higher lows, you've got what's called a bullish divergence. So you want to look for those in those instances and be prepared, because that's going to give you a heads up that the supply-demand model is changing and that you're going to get an upward cross. So when you see stuff like that, that can get you in a little bit early in terms of a cross like that. Okay, and that's something we'll be talking about too. On a 1-minute chart, it's basically the same thing that we're talking about. Again, you're going to see that when we actually get into trade setups, we're not really focusing on the actual moving averages. That's just going to help determine whether we're going to focus on long setups or short setups. And then what we're going to do is, after we get through the moving averages and we start focusing on setups, you'll be able to see exactly how to do that from there. Scott, how do you reconcile differences in moving averages on the different time frames in your day trading? How do you mean? Do you mean that, like, if the 60 minutes crossed higher and the 5 minutes crossed lower, what do you do? Is that your question? Okay, that's a great question. This next slide kind of answers that question, and the key with that is that the larger the time frame, the more power that more influence that has on the market. Okay, so think of it this way: if you've got, say, a weekly chart, okay, and it's got a crossover to the upside, think of that as, like, say you're at the gym and you're trying to do a bench press. Okay, a weekly chart bench press is going to be like 1,000 pounds. So that's going to be a lot of pressure on your chest, and the idea is that there's really nobody out there on this planet that can bench press 1,000 pounds. I think somebody got up to 900, but nobody's been able to bench press 1,000 yet. So the point of this is that if you've got a weekly chart that's got an upside crossover, think of that as 1,000 pounds of pressure, meaning nobody can lift it. Then you shouldn't fight it. So if you've got a weekly chart that's got an upside crossover, that means on a bigger picture scale, the supply-demand situation is higher and that you're in an uptrend. A perfect example of this, and we'll look at some charts later, is that in March and April of 2003, we bottomed and the weekly charts turned higher in terms of having a crossover. And a lot of people were shorting into July, September, and August, or July, August, and September of 2003, and I couldn't believe that the market kept racing higher. Well, if they would have just looked at the weekly chart, they would have seen that the moving averages crossed higher, and actually didn't really cross lower until about a month and a half ago. So we've been in a buy signal on the weekly chart for the last year and 3 or 4 months. So during that time frame, if you were playing the short side, that whole time, you had a rough time of it. If you just focused on the same side as the supply-demand situation on the weekly chart, you would have been in good form. So what? That's funny. So now what happens is that, let's say now you go down the daily chart. The daily chart is still a very powerful chart, but the weight's going to move down. You know, the weight on a daily chart compared to a weekly chart is going to be like 200 pounds. So it's still heavy, but it's still movable. So if you've got, and then if you go down to like a 60-minute chart, that's like 100 pounds. And if you go down to a 5-minute chart, that's like 2 pounds. So the whole idea then is that, let's say you've got a weekly and a daily and a 60-minute chart. They're all pointing higher, right? All the moving averages are pointing higher. So what are you going to do? On a 5-minute chart, you ignore, because you're on a 5-minute chart, you're going to get like crossovers to the upside and crossovers to the downside like 3 or 4 times a day. So in that particular instance, you would ignore the sell setups and just focus on the buy setups. So when the 5-minute chart crosses over to a sell side and you've got all the major time frames above it pointed higher, just ignore the sell setup, because that's going to be a low probability trade. You want to trade on the same side as the weekly chart, the daily chart, and the 60-minute chart. So when you get that next 5-minute crossover to the high side, yeah, you're all over that and you take it. So now when it gets trickier is if you've got the weekly chart in a buy and a daily chart in a sell and then a 60-minute chart in a buy, you're going to get mixed markets. And on those days, especially intraday, you can focus on both long and short setups. On days where everything's pointing higher, ignore the sell setups and focus on the long side. on days where everything's pointing lower, which is what in a situation we are right now, I tend, like for this whole week, every time we got a buy signal in the room, I pretty much ignored it, just because everything's pointing lower in unison, and that's when you get the most powerful moves. When you got the weekly, the daily, and the 60-minute chart all moving in conjunction, you get the most powerful moves. So does that make sense to everyone? Okay, great. Okay, this next slide I just forwarded to. That's basically just what I talked about. So we're just going to keep moving here. Again, this is more stuff that I've just already talked about. And the reason that we like to keep this stuff in the manual like this is you can actually go through and reread it, but it's the same thing. In this particular slide, I'm talking that you can use the moving averages as a specific trading strategy by themselves, but we have found other setups that are better, they're faster, but what we like to do is we like to use the moving averages as a gauge, okay? When we talk about squeeze plays later, we'll sit there and go, okay, it's a long squeeze, but I'm not going to take it because the daily and the 60-minute charts are pointed lower. So I'll ignore the long squeeze, but I'll go ahead and take the next short squeeze that sets up. All right, and that's when we start talking about that. That's what we mean. The one thing that I like moving averages for is for moves is that you can also use them as kind of a trailing stop too. When you get a strongly trending day, the toughest thing on days like this is to wonder, okay, when do I get out of this market? I mean, is this going to reverse or not? So on this particular chart, I've got an 8, a 21, and an 89 period moving average, and you can see that the markets are just falling. Well, the idea now is when you come down here, you're wondering, okay, now is the market just going to bounce back and go to new highs? Well, what you can do is on the 8, if the price cannot exceed the 8 and 21 period moving averages, there's no reason to cover. So in this particular situation, you basically just ride the markets down until they cross back up above their 8 and 21 period moving averages. In this particular case, it didn't really happen until after hours. But this is how you catch the bigger moves. You can use a faster signal to get in, and generally what we'll do is we'll get into a trade, we'll take off 10 or 20 points, like on the Dow, and then we'll have a second half position with a break-even stop, and then we can just stay in that position as long as the market is willing to move in our direction. So on days like this, we get into a trade, and you can just stay in it and stay in it and stay in it until, and basically until it can cross back higher. Now those days don't happen all the time. More often than not, you're going to get days where you're just taking 10 and 20 points at a time out of the Dow, but it will help you stay on those days, which do happen once in a while, and they've been happening over the last couple of weeks with increasing frequency. It'll keep you into the entire move. Yeah, Sarah, basically what you want is that you can see here on this one how it kind of came up here and tried to get through them and it couldn't. Right here it tried to get through them and it couldn't. It didn't even happen that day. What you want to see is that you want to see the price action. You want to get a closing bar through these levels. So you could get a bar like poking up above it and then fall right back down. What you want is a bar to close above these levels. So basically, if it's just riding it all the way down, we'll just stay in it. All right. Sure, no problem. So the key with moving averages, if you actually use moving averages by themselves, you're going to be at a disadvantage from other traders. You want to use these in conjunction with other tools, and they're a very important role because it's a very visual way to stay on top of the market and stay on the path of least resistance, but you definitely want to use these with other tools. But by understanding the nature of moving averages and how they work with what I call the supply and demand situation, you're going to be able to filter your trades and therefore give you better odds at being a successful trader. Just because the moving averages are going to tell you, even though you may not use the moving averages as an entry signal, you'll still know and say, okay, because this long play is setting up, I'm going to ignore it because of what the moving averages are doing, and therefore you're going to increase your odds. So that's the main thing I want to tell you about moving averages. There are some specific plays that we do look at with moving averages, which Hubert will show you in a second. But that's the main thing that we use moving averages for our intraday trades, is basically for staying on the right side of the market. You can also use these in conjunction with other tools, like right here, you've got the Fibonacci's. And I do like to see Fibonacci's, just especially on larger levels. I don't use them so much intraday. We do use Fibonacci clusters, which you'll see in the room. But on bigger charts, I like to know where the key levels are. So you can see that, if you get a crossover like at a key level, that makes it pretty important. So up here, the market came down to, pulled back to its 23.6 retracement, and instead of the market bouncing at that level, the moving averages actually crossed over. That shows you that the market is basically rolling over, and in fact, this was the market. This ended up being the market top this year. When you come down to a key level on the Fibonacci's, like right there, and the moving averages actually cross over instead of the market bouncing off that level, it's just setting up the next leg down. And on this particular case, this was the highs, and the markets just stair-step their way lower and continue to stair-step their way lower. And in fact, from that level, they're down almost 900 Dow points. All right. This one here. This is a video that'll be in the archive that will show you. This shows live market action with some moving averages. We're actually going to be able to see how that works on Monday. And again, in talking about this being in conjunction with other tools, what you're going to see is that as we go through and set up these other charts, you'll see us, whether we're drawing trend lines or Fibonacci's, you're always going to see these moving averages on the charts that I show you. And the reason will be for that is that, if you get, right here, the markets pull back and form the bottom of a trend line, and you can see these moving averages never cross down to the downside. So when you've got a market pulling back and the moving averages don't cross, you'll know that there's the high odds of this support level holding. So that's another good reason to use these things. It just gauges the strength and weakness of the current market condition. Now, here's one of my favorite plays for swing trades. And I want to take a few minutes here and just talk about this. Let me ask a question real quick. Do you guys all understand what an RSI, what a bearish or bullish divergence is? Because if you don't, I want to explain it here so you know. Is there anybody here who does not understand what a bullish or bearish divergence is? Okay, I'm just going to go through real quick so you understand, because these are really, really important. All right? Now, what I've got here, this indicator down here, all right, this is called a relative strength index, or RSI. And I use a 7-period RSI, okay? You can see there the 7. By default, these set up on TradeStation as 14 days. And I don't find that they react as fast as they should. So I've changed it, and I've tweaked around over the years, and now I use a 7-period, and I use this on all time frames. What I'm looking for are divergences. Okay, what does that mean? All right. You can see that right here, the RSI made a high, okay? And, oops. So RSI has made a high right there, and prices, okay, we're right there. All right, so you just want to know, where was the RSI when prices were right here? So you connect that level, all right? So now, then you just look for the next pivot high. So the next time prices make a high is right there, and then just come down and draw a line and see where the RSI is, all right? So look at this. You've got prices making higher highs, okay? They're trending higher, but the RSI is making lower highs. This is a divergence, okay? These are very, very important. If it was a strong market if you had the market making higher highs, the RSI would also be making higher highs, confirming the move, okay? When an RSI is making higher highs with the market, that confirms the move. In this particular instance, the RSI is not confirming the move. All right? Does that make sense to everyone? It's a very simple concept, but you got to understand it, because it's a very important on a lot of different time frames. So here you can see then, okay, prices went on to make, again, higher highs, even higher highs. So here we are at the peak, higher highs. And where's the RSI? It's still making lower highs. And so what we have here is we've got a trend where prices are making higher highs, okay, yet the RSI is making lower highs. So you've got one going up, you've got one going down, and that's called a bearish divergence. All right? Now, just so we're clear, a bullish divergence, what would happen in a bullish divergence, and actually there's a little one right here, in a bullish divergence what happens is you'll have prices making lower lows, yet the RSI is making higher highs. So again, the RSI is not confirming the move. If the RSI was confirming the move, then while prices were making lower lows, then the RSI would make lower lows. All right? So the whole key here is either you have convergence, which is confirming, or you have divergence, which is non-confirming. All right? I don't really care so much about confirming. If the move's being confirmed by the RSI, that's great. I'll just continue to play it. But when I see a divergence, then I see that a potential shift in trend is about to happen, and that's why I want to be on top of those. Roger, yeah, you always need two peaks. So the whole key with this is that you have to see how it relates. So you got to get like right here. Okay, so you can see that this is already starting out right here. You want to get here's prices make new highs. Okay, let's say this is the first day you look at the chart. Prices make new highs. So now, how does that compare with the last time the market made new highs? Well, the market's made new highs here, and the RSI was higher. So you need two peaks to compare. All right? If you only have one peak to compare, you always want to compare. So the whole idea is you just want to compare how does this peak and this price compare with the next price and the next peak. That's all you need to do. So you need at least 2 points. Bradley, that's a good question. I do a lot of work with MACDs and stochastics, and for divergences, I have found that the 7-period RSI works better. I'm not sure exactly why, because I do see divergences in MACDs and stochastics. I've just found that the 7-period RSI is faster. It'll set me up quicker for these trades. So that's why I like it. It works really well on smaller time frames too, intraday. I mean, we're looking at a daily chart here, but it works great like on 1 minute and 3 minute charts too. So what I want to show you for swing plays, sure. How I use this on swing plays. Now this is very important because this is where this all ties together. And this is how you use this for a swing play, okay? So now you've got a divergence here, right? You're making lower lows on the RSI, you're making higher highs on the stocks. So that's telling you that the market's going to fall apart. Now the question is, when do you get short? Well, now here's where the moving averages come into play. When the moving averages start to roll over, that's when you get short. So here's the heads up, all right? So right here you've got the heads up that the market's basically going to fall apart. But the 8-period moving average is still above the 21. It's still above the 21, okay? Still above the 21. And you can see this happened through February through March. So basically, for a whole month, the market still kind of moved higher as these two moving averages were above each other. Now here, they finally start to cross, okay? And you can see that's, even though we started getting this divergence back here in January and February, we didn't get the moving average cross until March. So by waiting for the supply-demand situation to change, you actually saved yourself a couple of months of heartache. You get in when the moving average crosses, and boom, that's your entry point. So that's how you use moving averages in conjunction with RSIs and in conjunction, like with the Fibonacci's. And on something like this, basically, a good target is when you get something like this, you're looking for a 50% retracement. So boom, we come down to a 50% retracement, we cover, and we're done. On this particular play, we got short at 10,600, and this is a swing play, so we're holding it overnight for until we get until our target or stop is hit. So we get in at 10,600, and we get out at the 50% retracement at 10,144. Okay, so a little over 400 points in the Dow. So that's a nice swing trade. And these don't happen all the time, but when they do set up, they're very nice. On something like this, I like to use kind of like a one. It's one of those things where you can use a normal 3-to-1 risk-reward ratio. On here, we're looking at a 50% retracement. So we're looking at a potential 560-point target. On something like this, I'm just going to use the highs, a little bit above the highs as a stop. So it was about a 130-point stop for a potential 540-point target. Now, you actually don't have to use that much of a stop. You could actually use the previous peak, which was right here, and that would have given you about an 80-point stop. But the idea, of course, is that you want to, if you're going to use something like a 140-point stop, you just want to, manage your position correctly. So if you normally would trade 10 contracts, if you have $100,000 and you normally trade 10 contracts, well, because you're going to be using a wider stop on this play, you probably only want to use 5 contracts. That's all something that we're going to talk about in our business plan, which is going to be, we're talking about either tomorrow or on Monday. Okay? You guys have any questions on this? Because this is a great setup in terms of, not only does it keep, even if you don't do swing plays, this shows you how to read the markets in terms of, is the market going to be going up or down in the near future, and can also help you with your intraday plays. Because if the market looks like it's rolling over, guess what? You're going to be focusing on the short side instead of the long side. There was a couple of months here where it made a lot of sense to play the long side, and then there was a couple of months where it made a lot of sense to play the short side. And that's how it's part of the way you determine market direction like that. And you can see that stuff like this, it tells you what's going on in the markets as opposed to watching CNBC or, watching somebody else say, okay, I think stocks are going to go higher because of this. These charts will tell you all that you need to know, and they're less confusing, and there's less conflict of information coming in. It's very clean. It doesn't matter what people are saying. All that matters is what stocks are doing. Yeah, I will explain MACDs and stochastics tomorrow, how I use those. Bradley. All right, so for moving averages, basically to catch bigger moves in the market, and this is really more for swing trading, but I like to use a combination of the daily and the 60-minute charts, the 8 and the 21 period EMAs, or exponential moving averages, Fibonacci levels measuring the swing highs and lows, and then the 7-period RSI. And what I'm looking for are major turning points in the markets. And I'll use these not only for swing plays, but I'll also use these to help me pick and choose which side I'm going to focus on an intraday basis. Okay? So those all tie together very importantly, and so it's important to watch those. So if you guys are if you guys are looking at the newsletters I put together each night, that's stuff that I'm looking for every night. It's okay, the RSI, we've got a bearish divergence, but the moving averages haven't crossed over yet, and those are different things that I'm looking at. So this is stuff that I'm looking at every day. All right, this next slide basically just tells you everything, just documents everything I just told you on that chart. So if you guys need to go back and look at this in more detail, there it is for you. You can also see, we talked earlier about a bearish divergence. Here's an example of a bullish divergence on page 89. So look at this. So look here. Here, prices made a low right here, and then you come down and look at where the RSI is. Okay, you see that? Now prices came down here and made a lower low. Come down, see where the RSI is. All right. So you've got prices heading lower, and you've got the RSI heading higher. That's a bullish divergence. And whereas before we were looking at a bearish divergence setting up on the daily chart, now on this particular chart I've drilled down, and when the stock market comes down to that 50, remember when the stocks came down? Let me back up here. Because I want to show you something. All right, so take a look at this part right here, okay? See this part right here on the daily chart? What we're going to do now is, on that other slide, we're going to drill down, we're going to go to a 60-minute chart and zoom in on this level, all right? So now, let's go to the 60-minute chart. All right, so now, Tim, I'll get to that here in a second. On the, so this is that part that I circled on the daily chart. Here it is on the 60-minute chart, okay? And this is important to look at different time frames like this. Because what will happen now is you can see that, you remember when I said that we're going to use the 50% retracement as a target? Well, what you could do is wait and see if we get down to this level, or do we have any divergences here? And you can see that when we got down there, we had prices heading lower, the RSI heading higher, which is a bullish divergence, meaning prices are about to shoot higher. So not only did we use the 50% retracement level as a target for that particular move, you could also use the 60-minute chart to give you a heads up on when the market was going to turn. Okay. Tim is asking, is there any significance to the changing colors is there any significance to the changing colors in the RSI? Basically, if it's red, it means it's overbought, and if it's blue, it means it's oversold. But I don't really use this as an overbought or oversold indicator. I have them colored like that on TradeStation, just so it's a visual reference. You know, basically, if it's oversold, I'm going to be looking for a potential bullish divergence. If it's overbought, I'm going to be looking for a potential bearish divergence. All right? So these next couple of slides, they just basically detail what I've told you. Page 90 here. And so on this particular one, so this is kind of a recap of all the trading, of all the moving average stuff that we just talked about, okay? The moving averages, they're a visual reminder to go with the flow. There's no reason to be a hero and try to pick tops and pick bottoms. Don't fight the moving averages. You know, if you've got an upside crossover, great. Focus on your long setups. When you get a sell side crossover, then you focus on your short setups. And then you use the 7-period RSI to give you a heads up when the market's going to change direction. Remember, markets don't rally because of good news or bad news. Markets rally because the available demand for stocks is greater than the current available supply of stocks. It's very simple economics. And vice versa, prices are going to fall when the available supply of stocks is larger than the current demand for stocks. So don't try to sit there and justify it with fundamental analysis. We're going up because there's not enough stock out there to satisfy the need of current buyers. That's the only reason. Don't get caught up in the PE ratios or what they're saying on Bloomberg or CNBC or anything like that. The moving average will keep you from fighting the trend, and it's going to keep you on the path of least resistance. It gets rid of emotions and bias, and most importantly, it keeps the trader from catching a falling knife in the terms of a falling market or holding back a freight train in terms of trying to short tops. Now, Hubert's going to talk a little bit about a specific trade he does with moving averages on KLAC. And what we're going to be doing now is after that, we're also going to be, the rest of today, tomorrow, and Monday, we're going to be talking about the rest of the trade setups that we use, and we'll refer back to, you're going to hear us say, all right, we're getting a short squeeze here, but we're not taking it because of X. And part of that's going to be the internal indicators. which we've already reviewed, and it's also going to be the status of the moving averages, which we're reviewing right now. Okay? So I'm going to pass this over to Hubert. And what page are we going to next? I think was it like 3 something?
342.
All right, we're going to go to page 342 in the manuals. Okay, 342. And I'm going to pass this back over to Hubert.
Okay, let me give you a little background on Clack. I've traded Clack for a very long time, and for about 3 or 4 years straight, it's all I traded. It was like 98 or 99% of my trading. So when I'm talking about Clack, I actually know what I'm talking about because I have traded it day in and day out for a solid 3 or 4 years and nothing else, okay? I actually traded it before I got started in futures, so these are a handful of trade setups that I use to trade Clack on a consistent basis, okay? Now, the ones I trade are gaps, 200, let me get the pencil. I use a gap strategy, just like I do on the Dow, and I've got it broken down statistically for you. I use the 200 MA and the 500 MA crossovers, okay, on Clack. A couple rules for Clack. If it's below its 200 period average on a 2-minute chart, it's bearish. If it's above its 200 period average, it's bullish, okay? So there's that trade. Then we're going to go over 1, 2, 3 buy signals and 1, 2, 3 sell signals on Clack. Then we're going to go over a ping pong trade on Clack. And then we're going to go what I call trips. It's a triple signal. It's a combination of the RSI, the stochastic, and the MACD. Okay. This slide is actually messed up. It should show the exact opposite. When 200 crosses through the 500 to the upside, it's bullish, and then you should add in here when the 200 crosses through the 500 to the downside, it's a bearish setup. So that's been omitted. That needs to be added to that slide. That's slide 343. Okay, these are just some rules. Now we're going to get started. Okay, this is an intraday chart of Clack on a 2-minute basis. The red line is the 200 period, and the blue line is the 500 period. When I'm trading Clack, I'm just scalping Clack. I'm not looking to make 3 or 4 points in Clack a day, although it does happen. I'm looking to scalp 50, 60, 70 cents, 80 cents, 90 cents, sometimes point and a half. Okay, so as you can see, when the red line, which is the 200, crosses the 500, I go short at 46.73. Okay, and then I'm not giving you any exits out. I'm gonna go over those just a little bit. They're just straight up periods in TradeStation. They're just period averages. It's just the default. When you choose 3-line moving average, it's just a 200, and they're simple though. They're not EMAs. They're actually period averages. They look back 200 periods, but they're just straight up simples. Okay. And these are super simple. Okay. Here's you another one. The red line crosses through the blue line. The 200 crosses through the 500. I go long at 45.10. Okay. And my style is a little bit different than John's. I kind of repeat the stuff over and over and over until you get it ingrained in your head. Let me hold on. I messed up the chart here. Okay, hold on just a second. Okay, all right. Next slide. Okay. Now I'm going to go over Clack 1, 2, 3 sell signals and 1, 2, 3 buy signals. The criteria are you have to have three checks that have to come in place. The candle must slice through the 200 period average like a hot knife through butter. Okay, that's the first candle. This is a Clack on a 2-minute chart, and you use a 200 period and a 500 period, or a 200 simple moving and a 500 simple moving. Step number 2: the price must retrace and retest the 200 MA. Just test it. It needs to close. It needs to close below it. Okay. And then price must move lower and take out the body, which is the close of the candle, or you can use the wick, but I like using the body, okay? And here's a visual representation, all right? Step number 1 is right here. The pink line is the 200, okay? So as soon as this candle here slices through the 200 day, right here, that's step 1, okay? You guys got that? As soon as the 200 slices through, as soon as price action slices through the 200, step 1. Alright? I'm going to follow the price action here with my pencil. Now, then what it does is it retraces back up to the 200 moving average here at step 2. It kisses it, it just touches it, and it closes below it, okay? The third step of the strategy is the next candle that closes below candle number 1 that went through the 200 day moving average, that's the one I go short on, okay? You guys got it? It's kind of a weird setup, but after you learn how to look for it and you train your eye to look for the 1, 2, 3 sell and the 1, 2, 3 buy, it's a real good strategy, and it works a lot. I made a living for 3 or 4 years just doing these 3 or 4 trades on Clack. You guys have any questions on the 1, 2, 3 sell signal on Clack? I don't know if it can or not. I don't trade single stock futures. The 2 things that I mainly focus on and I'm responsible in the room for are Dow trades and Clack trades. That's pretty much the only things I trade. I do swing stocks some in my IRAs and we manage a retirement account for our companies and stuff. But these are the ways that I create income. What would you use as a stop? I use a 25 or a 50-cent stop. Here's what I do. When candle 3 here, you see this line right here? You see the close of number 1? Well, number 3 candle broke through it, okay? As soon as it pierced that price action, I went short at 46.39. Yes, there's also a 1, 2, 3. I'm going over the 1, 2, 3 buy signal as soon as I get done here. I have no. That sounds good, Malcolm. I have no clue. I'm not a Elliott wave guy. And this is just. I find these patterns just with my eye and stuff. Profit targets are also I'm taking off half at a quarter point, and I'll take a quarter off at 50 cents, and I'll let the last quarter ride. The black line came from the first signal. Did you see where this candle sliced through the 200 day moving average? This candle right here, it's just the close of that first candle right here. Okay, right here where my mouse is. And then that's criteria number 1. Criteria number 2 is it retraces back up to the 200, and then criteria 3 is it must take out the body or the close of candle 1. Profit targets are I scalp intraday more than I do anything, so I'm taking 25 cents, 50 cents, and then on the last quarter, I pretty much manage the last quarter just based on market internals and what the market's doing. But I'll take some off, depending on the price action and how Clack is acting. It'll either be 50 cent profit target or a 25 cent profit target. Same thing, stop will either be 25 cents or 50 cents. It kind of depends on the beta of it for that day based on how it's moving. Okay. Anybody else got anything on the 1, 2, 3 sell on Clack? It's important. It's got to be the 200 day moving average. All right, let's go on to the next one, which will be the Clack 1, 2, 3 buy signals. All right. Same criteria. Candle must slice through the 200 moving average like a hot knife through butter to the upside. Price must retrace and then retest the 200 moving average and close above it. And then the price must move higher and take out the body or the close of the candle number 1. Okay? Here's an example. Alright, step 1 is this candle right here. This candle slices through the 200-day moving average. Boom, right here. Step 2, then it goes on to rally. You do not chase. You let it come back, touch the 200-day moving average, which is step 2 right here. Okay? When it does that, as soon as it does that, what you do, let's back up a little bit. As soon as this candle goes through the 200-day moving average, I'm drawing the line right here at 44.09, okay? As soon as this candle goes through the 200-day, I'm drawing the line at 44.09. And the second thing I'm looking for is I'm looking for a test of the 200-day moving average, which is right here again. Close above it, and then step 3, this candle took it out. I go long at 44.09. And then I'm long at 44.09, and then I'm just exiting the trade up in these areas. I'm just taking my profits, okay? Anybody got any questions on the 1, 2, 3 buy on Clack? Every technique that I use is super, super common sense, super, super simple. You got to be able to teach this stuff to like a 12-year-old. Because my daughters and my son, they're going to have to be able to trade too, so. It does not only work on Clack. I'm sure it will. I'm sure it will work with other stocks. It's just I only trade Clack intraday. I'm a firm believer in you've got to really get laser focused and good at a couple things. I'm not smart enough to be a jack of all trades and be trading 14, 15 different markets. If I can laser focus on Clack and get half a dozen trade setups that work consistently, I'll do it. Yes, these are all day trades. Now, the same thing, this will work on the Dow Minis if you use the pivots instead of the moving averages. It works really good. Okay? I'm just exiting out at 25 and 50 cents profit targets on Clack. That's all I'm doing. So as soon as I have 25 cents or 50 cents in the trade, I take half off initially, and then as soon as I'm up 50 cents, I take a quarter off, and then I've got a quarter left, and I manage that last quarter. It'll either be a break-even stop or a break-even plus 12 cents, and we'll just see what the market gives me on that last quarter. I kind of reward myself on that last quarter, and I do this with the Dow Minis too. I try to, if I take my mechanical signals and I manage correctly the trade setup with 3/4 of it, then I reward myself with the last quarter to see if I can squeeze a little bit more blood out of the turnip. Alright, let's go on. Okay. Now, what we're going to do is we're going to go through ping pong trades, okay? Now, the number one rule is on the number one rule on ping pong trades and Clack in general, the 200-day moving average. If the price action is below the 200, you want to have a short bias. If it's above the 200 on the 2-minute chart, you want to have a long bias, scalping it, okay? Now, this is what I call a ping pong trade. The 200 is the pink line. The 500 is the blue line. Okay? All I do, as soon as it breaks the 200-day moving average, I will play the range. I'll enter at the pink line, and I will exit at the blue line. It's called a ping pong trade, okay? And it's just because you're playing ping pong between the lines. You enter at the pink line, the 200, exit at the blue line. Now, you can also reverse, which is a question I get a lot, and go pong ping. But usually I like the ping pong better than I like the pong ping. Okay? Another tool that I use, which is one of the indicators that we use, is the TTM trend. Okay? And I'm going to go over that tomorrow. As you can see, this kind of gave me a heads up. As it broke through the 200-day moving average, the TTM trend down here was red. Okay? So as I'm entering right here, just look directly below, and the TTM trend was red right in here. So it actually set up for a pretty good trade as it goes lower, okay? You guys got any questions on this one? Yeah, I trade a lot of size, so yeah, it'll pay for mine just fine. No, I did not get on the initial break. No, you didn't get You didn't get a red bar close until right here on this line here, and I didn't get stopped out. Stops on the trade, same thing. It's 25 cents and 50 cents. Blue line is the 500-day moving average. My stops are almost automatic. It's 25 cents or 50 cents on Clack, and on the Dow Minis it's always 10 points. So I never have to think about, oh God, what should my stop be now? It's always the same. It's either I'm right or I'm wrong or I'm gone. I can, yes. I will. If I'm out of 3/4 of the position, I will move my stop down, yes. Correct, Bradley, yes. That's correct. I don't touch it until it closes below the 200. And then I have a bias. As soon as it breaks below it, I want to be on the short side. As soon as it breaks above it, I want to be on the long side. And you guys can pull up a charts of Clack and just look at the 200-day moving average and of the 500-day moving average, and look at the movement that you see that thing gives you around the 200-day moving average. You guys ready? Any more questions on ping pongs? Now, here's another one. Here's a ping pong. Same thing. Enter, close above, ride it to the blue line. Also, notice what did I have going for me in my favor here? Blue TTM trend. Blue TTM trend. Long signal, it broke above, closed above. Right here. Ride it up. And I was relatively confident because the TTM is blue for me, which is a confirming indicator that we use. Okay. Going to the next slide. Let's see here. Okay. Alright. RSI, stochastic, and MACD. Used individually, I really don't. I think they're worthless. If you put them in combinations of 2 or 3, I think they're really effective. And using this methodology based on swing trades with Clack, it will always miss the first 25% of a run, and it will always miss the last 25% of the run. But what it will do is it will enable you to get the meat in the middle of the trade, which is what's important. I'm not interested in buying lows and selling highs. I'm interested in letting it run a little bit, confirm it, and go long, let it roll back over, and exit it. Okay? If you are in the business of buying bottoms and selling tops, you will be out of business fairly quickly. Signals must fire in sequence. RSI divergence must fire first, followed by a stochastic cross, followed by a MACD cross. Be patient and wait for all 3. And you guys, John just went over divergences, didn't you? Yep. Okay, so you guys know how to do those. So I'm going to give you an example of how I swing trade Clack in some of our IRAs, our retirement accounts, and our company plans. Okay, signal 1 is you have an RSI you have an RSI divergence at 0.1 here, okay? The price went to a new high, RSI did not, okay? Signal number 2 is down here. You have a stochastic sell signal, okay? Signal number 3 is right here. You have a MACD crossover sell signal. You get short on this bar here. You are short at 58.60. You guys got any questions on this one? What period is the RSI? It's just the default. Since they are, hold on, Malcolm. Yeah, it's just a default RSI. I'm looking for anywhere from a 1 to a 10-point gain in clack is what I'm looking for on these type moves. Since they are all calculated from the same information and are strongly correlated, how do they actually confirm each other's sequentially less sensitive parameters? Well, look at here. Here's what you're looking for, Malcolm. Let me go over it one more time, so maybe it'll make it a little bit easier for you. I have an RSI divergence here, and then I have so I have an RSI divergence here. Alright. Then I have a stochastic cell signal here. Then I have a MACD cell signal here. Now, if I'd have had an RSI divergence and no stochastic cell signal and no MACD cell signal, you'd do nothing. Okay? Which in this case, it went from, 58.60, and clack's still going down since this happened, so. Does that answer your question, Malcolm? Stops are a little bit based on how your trading plan is set up, but you can use usually the previous day's high or the high of the move. Yeah, this is a swing trade. It's not intraday. It's a swing trade. Okay, here's another example. We have a RSI divergence here. We have a higher price action high, and RSI did not confirm. We have a stochastic sell signal here at 0.2. Then we have a MACD sell signal at 0.3, short at 44.93, and rider down. And you can see it bottomed out around 44.30. So even if you used the previous high or the high of that day, you can just scale out in 1, 3, and 6 points, or you can use fib numbers. I do not use it intraday. No, it's pretty much. You can use it for swings. It'll give me a heads up on my scalping. But if I do it intraday on a 5-minute chart, what I will do is I'll try to get enough cushion in this trade at 44.93 and try to carry some of it into the next day and turn it into a swing trade. I will do that, but it's only on a 5-minute. I won't do it on like a 1, a 3, or a 2, just because it's too laggy on those time frames. 5 minutes works good. 15-minute works pretty good. Okay, now I'm gonna go through some clack gap logs. I trade clack KLAC's gaps like I can't even talk, man. It's pathetic. I trade clack's gaps like 1, 2, 3. I trade clack gaps the exact same way that I trade the Dow mini gaps. I go back and I look at the statistics. I have a program in TradeStation where I can actually tell it to go back and look for all the gaps in clack and tell me the percentage of the time that they fill within the first day or within the first 30 minutes. Okay? So now you can see the gaps in front of you. This was based on a 2-minute gap report for clack from 2001 to 2004. A gap of 0.35 points, and the gap is closed if it comes within 2 cents. Okay. The numbers of days tested were 700 or 699, close enough. Number of gaps found 330. It gapped up 165 times. It gapped down 165 times. Number of gaps filled, 181. The percentage of the total gaps that CLAC fills is 54.8. Okay? And then what I do after that, and you can also see, I break it down based on every 5 cents. A 5 cent gap on CLAC, and I have them based on times too in my workbook. A 5 cents on CLAC fills 65% of the time. 20 cents, 63.1. Hey, right down there, I need to go from like 5 all the way up to 10 and 15. I omitted it. A gap on CLAC of 25 is 60.8. A gap of 30 cents fills 59.9. Gap of 35 cents will fill 58.2% of the time. Gap of 40 cents gives me 56% of the time. And it pretty much falls off the cliff here when I start getting past 55 cents on CLAC on the gap fill. So I stopped doing it at that time, okay? Yes, I am the same day, correct. That is correct. Question was, you're referring to the gap being filled the same day, correct? And yes, that is correct. Okay. Now I've got, you can scroll through your manual there. I've got every gap all the way up to like 3.5 points. Now here's a couple of tools that I'll use to trade the gaps on CLAC. Okay. Now one thing here is what I look for is I'll use the gap. I'll note how much the gap is, and I've got my cheat sheet next to me, and I'll be like, okay, this gap is X. It's got a so-and-so percentage of the time it will fill. Second thing I look for is the moving average. Third thing is the TTM trend. When the TTM trend changes from blue, you've got this gap up on CLAC right here, okay, above the moving average. All right. As soon as this TTM trend right here changes from blue to red, I'll go short it. Okay, looking for a potential gap fill. Alright? And I just scale out accordingly. Okay? So it's pretty simple. Once again, it's total, simple, easy to use. Alright, does everybody understand this trade? It's a gap up. It's within my percentages. The TTM trend goes from blue to red. I short it. Use the same stops and the same targets. Okay, let's go to the next slide. Alright, here's you another example. This one is an example of the percentage is higher for this gap fill, but it did not fill, and I could not enter it because the TTM trend would not let me down here. You see this, guys? So it's a real small gap. I mean, this one here is like 10, 15 cents. It's a high percentage play, but the TTM never gives me a confirmation of a blue bar to go, okay, it's safe, go. So I have to set this one out, which it did not fill that day. Okay? One trick you can do too is you can use a 1 minute down here, a 1 minute of the TTM trend, and it'll fire off for you better. You can use a 1 or a 2 minute. Like this can be a 2 minute chart, and this can be a 1 minute, and it'll help you out. Yes, Malcolm, I do use that a lot. Yes, I do. That's a good point. And the question was, would the TTM be useful to fine-tune the YM gaps then? Yes, I do. Do you use the 1 minute TTM trend for the 2 minute? Yes, I do too, Justin. I use it both. I've got a chart set up with a 2 minute and a 2 minute underneath it of the TTM. And then I have a 2 minute with the 1 minute underneath it. So yes, I use both. You guys got this trade? You understand it? They're pretty simple. It's just if you fine tune them over time. Is there a time frame that the TTM trend must confirm the gap trade? I use a 1 and a 2 minute is what I use, and I'll be going over some of those trades tomorrow too, combined with the squeeze trade. you just mess around with it. Oh, Roger K. They won't line up. You'll just have to crunch them. I never look at level 2. I think it's mental masturbation. I mean, it's good for nothing. Sorry. Oh, must it be confirmed within 2 minutes? Oh, on the clack trade, I want it to be confirmed within the first 15 or 30 minutes of the trade. I mean, if clack's not going to fill in the first 30 minutes, it's probably not going to do it. Yeah. All right, so let me roll through some more stuff here. All right, so here's another gap. And as you can see, I'm going to fly through this, and we have a gap here. Then we have clack with no TTM confirmation. It stays red. Never get a gap fill, so I'll pass on it. Well, just go to the next slide. You want me to go through hourly rolling pivots?
After I do pivots.
Okay, all right. Let me go through. Let me pause this for just a second here. I'm going to turn it over back to John, guys.
You hear me do a quick summary and then I'll save it? Sounds good. All right, great. So what we're going to do now, thanks for all that stuff on clack, Hubert. What we're going to do now is let's take a quick 5 minutes, and then we're going to jump into pivots. It's 3:30. We had planned to go to 4. Realistically, we're going to be going to probably about 4:30. If that doesn't interfere with anyone's schedules, obviously this will be recorded too. We just want to make sure that we get through the pivots today, and we don't want to rush through it too bad. But we will have most of the main concepts covered by 4. And then we're going to stay and just kind of go through the rest of it, make sure it's covered, make sure all questions are answered, and then we'll wrap it up. So let's take a 5-minute break. Right now it is 3:30, so we'll start. Well, why don't we take a 10-minute break? Let's just split the difference. We'll take a 7.5-minute break since we're all at home. We'll start again at about 3:37 and with the pivots, and everybody can take a quick restroom break and grab a drink or something, all right? So back soon.